Think about everything you learned in school. Algebra, the periodic table, how to dissect a frog, the causes of World War I, how to write a 5-paragraph essay nobody was ever going to read again. Now think about what you were never taught. How to pay taxes, how a credit card actually works, and how it's designed to trap you. What compound interest does to your savings over 30 years. The difference between an asset and a liability. How to read a contract before you sign one. You spent 12 years, minimum, inside an educational system. And it sent you into the most financially complex society in human history without teaching you a single one of those things. That wasn't an accident. But here's the thing that makes this genuinely maddening. The information exists. It has always existed. It's sitting in books that anyone can buy for the price of a meal. Books that have sold tens of millions of copies because people are desperate for what schools never gave them. Rich Dad, Poor Dad. The Psychology of Money. The Millionaire Fast Lane. The Richest Man in Babylon. I Will Teach You to Be Rich. Think and Grow Rich. The Total Money Makeover. These books didn't become bestsellers because people love reading about finance. They became bestsellers because entire generations grew up financially illiterate, and nobody warned them. Today, right now, we're fixing that. 5 money lessons that school never taught you. Pulled straight from the most powerful financial books ever written. Lessons that took most people decades of expensive mistakes to discover. You're going to get them in the next 12 minutes. Let's go. Lesson 1. Your paycheck is not your wealth, and spending it first is the trap. Inspired by The Richest Man in Babylon by George Clason and Rich Dad Poor Dad by Robert Kiyosaki. Lesson 1. And this is the foundational financial mistake that most people make every single month of their working life without ever realizing it. Here's how the average person handles their paycheck. Money arrives. Bills get paid. Maybe some groceries. Some subscriptions. A dinner out. A few online purchases that seemed reasonable in the moment. And then, whatever is left at the end of the month, that's what gets saved. Except there's usually nothing left. Because spending expands to fill income. Every time. George Clason wrote about this in 1926 in The Richest Man in Babylon. A book set in ancient Mesopotamia with characters in robes and sandals. And financial wisdom so accurate it still makes people stop mid-page and rethink their entire relationship with money. His most famous line? A part of all you earn is yours to keep. Simple. Almost insultingly simple. But here's the problem. Most people read that line and think, yes, obviously, I should save some of what I earn. And then they save whatever's left at the end of the month. Which, for most people, is close to nothing. Most people don't realize this. But Clason wasn't saying save what's left. He was saying save first. Before the bills. Before the groceries. Before the dinners and the subscriptions and the impulse purchases. The very first transaction that happens when your paycheck lands should be transferring money to yourself. 10%. Before you touch anything else. This is where it gets interesting, because Kiyosaki in Rich Dad Poor Dad takes this idea even further. He says the order in which money flows out of your life is one of the most revealing things about your financial philosophy. The poor pay bills first, then spend. Then save whatever's left, which is nothing. The middle class pay bills first. Save a little. Then spend the rest, feeling responsible the whole time. The rich pay themselves first. Invest that money into assets. Then figure out how to pay the bills with what remains, which forces creativity and resourcefulness instead of passive resignation. But here's the thing that makes this lesson feel genuinely uncomfortable. Paying yourself first isn't just a savings strategy. It's a statement. A declaration that your financial future matters as much as your landlord's business model, your phone company's revenue, and your streaming service's subscriber count. You are a bill too. Arguably the most important one. Start treating yourself like it. Lesson 2. The difference between assets and liabilities will determine your entire financial life. Inspired by Rich Dad Poor Dad by Robert Kiyosaki. Lesson 2. And this is the one that, once you see it, you cannot unsee. Robert Kiyosaki says the most important financial concept anyone can understand is the difference between an asset and a liability. And he says most people, including well-educated, high-earning people, have it completely backwards. Here's his definition. And it's so simple it almost sounds too simple to matter. An asset puts money into your pocket. A liability takes money out of your pocket. That's it. But here's the problem. Most people spend their entire lives accumulating liabilities and calling them assets. The car that requires insurance, fuel, maintenance, and depreciation every single month? Liability. The house that costs you a mortgage payment, property taxes, maintenance, and repairs every year? Liability. For as long as you're paying more out than it generates in. The designer clothes, the gadgets, the subscriptions, the upgrades? All liabilities. All money flowing away from you. Most people don't realize this, but our entire consumer culture, every advertisement, every social pressure, every status symbol, is designed to make you enthusiastically purchase liabilities while calling them rewards for your hard work. This is where it gets revealing in a painful way. Kiyosaki asks you to draw 2 columns. On the left, everything you own that puts money into your life. On the right, everything you own that takes money out. Most people, if they're honest, have almost nothing on the left. And a very long list on the right. That imbalance is the entire explanation for why so many people who earn good incomes still live paycheck to paycheck. It's not about what you earn. It's about the ratio between what you're building and what you're bleeding. And here's the thing schools should have taught you from day one of economics class. The goal, the actual financial goal, is to fill your left column. Deliberately. Aggressively. Over time. Stocks that pay dividends. Rental income. A business that generates cash. Royalties. Anything that sends money toward you instead of away from you. Every financial decision you make for the rest of your life should be filtered through one question. Does this add to my asset column or my liability column? That question alone, asked consistently over years, is the entire difference between building wealth and performing it. Lesson 3. Compound interest is either the most powerful force working for you or against you. Inspired by The Psychology of Money by Morgan Housel and The Automatic Millionaire by David Bach. Lesson 3. And this is the one where I need you to actually feel a number, not just hear it. Warren Buffett's net worth is over $100 billion. He started investing at 11 years old. By his 30th birthday, after nearly 2 decades of investing, he was worth about $1 million. Which sounds impressive until you realize what happened next. He kept going. He didn't stop. He didn't cash out. He didn't decide he'd made it. He let the compounding continue. And 96% of his entire net worth, over $95 billion, was accumulated after his 65th birthday. Let that land for a second. 2 decades of work produced 1 million. The following decades produced over 95 billion. That's what compound interest does when you leave it alone long enough. But here's the thing most people don't sit with long enough to truly understand. Compound interest doesn't care whether it's working for you or against you. It will apply its full, merciless, exponential force to your savings account. And it will apply that exact same force to your credit card debt. Most people don't realize this, But the average credit card in America carries an interest rate somewhere between 20% and 30%. Every month you carry a balance, that balance grows. And the growth grows. And the growth on the growth grows. The same mathematical miracle that made Buffett $95 billion is simultaneously doing something almost identical, in reverse, to the credit card debt that 40% of Americans carry month to month. This is where it gets genuinely urgent. David Bach in The Automatic Millionaire introduces what he calls the latte factor, the idea that small daily spending habits, compounded over time, represent staggering amounts of foregone wealth. A daily $5 coffee, invested instead, at a reasonable market return, over 30 years, doesn't just add up to a couple $1,000s. It adds up to hundreds of thousands. Not because $5 is a lot of money, because time is. But here's the problem that makes this lesson so cruel. The young are the ones with the most time, and therefore the most compounding potential. And schools sends them into the world with zero understanding of this. So they spend their most valuable financial years, their 20s and early 30s, accumulating debt and delaying investment, doing the exact opposite of what the math demands. By the time most people understand how compounding works, they've already spent the years where it would have mattered most. You haven't. Or if you have lost some time, you still have more than you think. The second best time to start is right now. Lesson 4: Taxes are the biggest expense of your life, and most people don't know how to legally minimize them. Inspired by Rich Dad Poor Dad by Kiyosaki and Tax-Free Wealth by Tom Wheelwright. Lesson 4. And I want to start with a number that most people have never actually stopped to calculate. What percentage of your working life do you spend working for the government? Add up federal income tax, state income tax, Social Security, Medicare, sales tax on everything you buy, property tax if you own a home, capital gains tax if you invest. For the average working American, the total tax burden sits somewhere between 30% and 50% of everything they earn. Think about what that means. If you work from January to December, you spend somewhere between 4 and 6 months of every year working entirely to pay taxes. 4 to 6 months. Every year. Of your one life. But here's the problem that school never once addressed. The tax code is not a simple flat rate applied equally to everyone. It's a multi-thousand-page document full of legal strategies, deductions, credits, and structures, most of which exist specifically to reduce what you owe. And here's the brutal truth about who knows how to use them. Rich people. Business owners. Investors. People who hired accountants and tax attorneys who specialize in legal tax reduction. Not employees. Not people who earn a W-2 salary and file a basic return every April. Most people don't realize this, but the tax code was not written to be fair to employees. It was written by people who understood business ownership and investment, and it rewards those structures heavily. This is where it gets clarifying rather than just frustrating. Kiyosaki explains the fundamental difference in how employees versus business owners relate to taxes. An employee earns money. The government taxes it immediately. Whatever's left is what they live on and invest with. A business owner earns money, spends legitimately on business expenses, equipment, education, travel, home office, health insurance, and then pays taxes on whatever's left after those deductions. Tom Wheelwright, Kiyosaki's own tax advisor, wrote an entire book called Tax-Free Wealth that explains this in detail. The title sounds almost illegal. It isn't. Every strategy in it is fully legal. They're just strategies that nobody teaches you unless you go looking. The fundamental insight? The government uses the tax code to incentivize behaviors it wants more of: business creation, real estate investment, energy production, job creation. Every time you engage in one of those activities, legally, through the proper structures, the government rewards you with reduced tax liability. The rich aren't cheating the system. They're using the system the way it was designed to be used. And the fact that school never taught you this? That's not an accident. An informed population of taxpayers is a much more expensive population to govern. This lesson alone, properly understood and acted on, could be worth more money over your lifetime than any other single piece of financial education. Find a good accountant. Not a tax preparer, a tax strategist. The difference in what they save you pays for itself many times over. Lesson 5. Your mindset about money is more important than any strategy, and it was formed before you were 10, inspired by The Psychology of Money by Morgan Housel and Secrets of the Millionaire Mind by T. Harv Eker. Lesson 5. The last one. And the most important one. Because everything else on this list, the assets, the compounding, the taxes, the systems, none of it works long-term unless this one is right. Here's a question that most people have never sat with honestly. How did the adults in your life talk about money when you were growing up? Was it a source of stress? Something that was always tight, always something there wasn't enough of? Was it discussed at all? Was it a taboo subject, something polite people didn't talk about openly? Was it something that other people had? Rich people? Lucky people? People who weren't like your family? Or was it talked about as a tool? A resource? Something that could be learned, grown, and managed? Here's the brutal truth that T. Harv Eker lays out in Secrets of the Millionaire Mind. By the time you were 7 years old, you had already formed your core beliefs about money. Your money blueprint. The unconscious programming that determines how you earn, spend, save, and think about wealth. And that blueprint, formed before you could even read, is quietly running your financial life right now. Most people don't realize this, but your money behavior isn't rational. It isn't a series of logical decisions made in the present moment based on available information. It's the output of a program written in childhood. By watching your parents argue about bills. By hearing that money is the root of all evil. By absorbing the belief that wanting more than you have is greedy. That rich people are corrupt. That people like us just don't end up wealthy. Those aren't facts. They're stories. Stories that were handed to you before you were old enough to question them. And here's where Morgan Housel and The Psychology of Money adds the layer that makes this complete. He says nobody's financial behavior is irrational from the inside. Everyone is making decisions that make complete sense given their personal history, their formative experiences, and the money environment they grew up in. The person who can't stop spending even though they know they should save isn't stupid. They may have grown up in a household where money was scarce enough that spending it felt safer than holding it. Because it might disappear anyway. The person who refuses to invest even though they understand compounding may have watched a parent lose everything in a market crash. Their caution isn't ignorance. It's a wound. This is where it gets genuinely transformational. The first step to changing your financial life is not opening an investment account. It's not reading the right book. It's not finding the perfect strategy. It's becoming aware of the story you inherited, and asking whether it's actually yours. Not the story your parents told you. Not the story your culture told you. Not the story your bank balance has been telling you for years. Your story, written by you, based on what you actually believe is possible. Because here is what every single book referenced in today's video agrees on, unanimously, across decades of research and real-world results. Wealth is not primarily a mathematical problem. If it were, every person who took a finance class would be wealthy. Wealth is a behavioral problem, a psychological problem, a belief problem. The person who believes, truly, deeply, without asterisks, that financial freedom is available to them, they make different decisions. They see different opportunities. They respond to setbacks differently. They persist longer. They learn faster. Not because they're smarter, because their operating system is running a different program. Rewriting that program, becoming aware of the blueprint you inherited and deliberately replacing the parts that don't serve you, is the work that precedes all other financial work. And it is also the work that school, in 12 years, never once assigned. 5 lessons. 0 of them in any school curriculum. All of them available in books anyone can buy. Let's run through them one final time. Pay yourself first, before bills, before spending, before anyone else gets a claim on your income. Understand assets versus liabilities, and spend your life building the left column. Learn compound interest and use it before it uses you, on your debt, on your delay, on your youth. Understand how taxes actually work. And find legal, strategic ways to keep more of what you earn. And finally, examine the money story you inherited before you were old enough to write your own. Here's what I want you to feel right now. Not guilty. Not overwhelmed. Not behind. Informed. Because the gap between where most people are financially and where they could be is not a gap in intelligence. It's not a gap in discipline. It's not even really a gap in income. It's a gap in education, specifically, the financial education that the school system failed to provide and that nobody in a position of authority seemed particularly bothered about. The books exist. The information exists. The strategies are documented, legal, and available to anyone willing to spend a few evenings reading. The difference between the people who use that information and the people who don't isn't talent. It's whether someone, a friend, a mentor, a book, a video, sat them down and told them it existed. Consider yourself sat down. Now here's the only question that matters after a video like this. What are you going to do with it? Not tomorrow. Not when things settle down. Not when I have more time. What are you going to do today? Pick one lesson from this video, just one, and take one concrete action before you go to sleep tonight. Open a high-yield savings account. Calculate your asset-to-liability ratio. Set up an automatic investment. Spend 30 minutes reading about how your income is taxed. One thing. One action. Tonight. Because here's the truth underneath all 5 of these lessons. Financial literacy is not complicated. It was made to feel complicated to keep most people dependent on systems that benefit from their confusion. You are not confused anymore. Use that. Which of these 5 lessons hit you the hardest, and why? Drop it in the comments. And tell me, which of these did you wish someone had taught you earlier? Because I read every single one and your answers genuinely shape what I make next. If you want more of this every week, the financial and life lessons that schools skip, broken down in plain language, subscribe and hit the bell. Links to full breakdowns of every book referenced in this video are in the description below. If one of these lessons landed, go deeper on the book that inspired it. I'll see you in the next one. Thank you for watching.